Welcome to this Edison TV with myself, George St. Quintin from Edison, and Gervais Williams, Head of Equities at Premier Miton. We're delighted to be joined by Gervais, renowned fund manager, as a manager of many funds, including the one we're going to be going into a bit of detail on today, the Diverse Income Trust. It's great to be speaking with you. Hi, Gervais.
Hello, George.
How are you? All good?
I'm very well, actually. Yeah, the market's been quite busy, but that's always great news for an active manager.
Great stuff. Yeah, great. Well, I think we'll just dive straight in if that's all right. You've had incredible performance of late. What's your outlook going forward, though, from here for the UK equity markets?
The nature of the UK equity market is we've had some headwinds over the last few years. In part, equity income has been a bit out of fashion. Obviously, long duration assets have been doing well, but also the same thing, we've had an overlay of uncertainty about the ongoing kind of question marks on Brexit. And with that being concluded, I think that's also dropped away. So headwinds have sort of dropped away, tailwinds are coming. I think there's still quite a lot of stocks out there which are not fully reflecting the prospects. And if anything, there's more opportunity going forward for equity income stocks generally. So overall, we're pretty upbeat about the prospects for the UK relative to other international countries.
Great stuff. Yeah, you're still managing to find those interesting opportunities in the small cap space particularly. Yeah,
it's interesting, isn't it? I mean, although we have quite a decent amount of holdings in some of the FTSE 100, FTSE 250 holdings, and actually some analysis we did recently suggests that we add value in those areas as well as the small cap and the AIM stocks. Interestingly, there's still, I don't think I've known a valuation differential between some of the very much, sort of favoured stocks, the fashionable stocks, which are really in many cases standing on very high valuations, and then you compare those with many of the more overlooked stocks, and in many cases they're regular stocks, but they're not very fashionable. And I think the differential between the top and the bottom is unusually wide.
One interesting thing about your trust, the Diverse Income Trust, is the put option that you've historically had. Not always, but sometimes. Is that in place at the moment, and what's the thinking behind that?
So the real thinking behind that is that we love things which are less correlated. So the portfolio tends to have about 130 holdings anyway, many of them in different areas, and having a put option gives us an access to an asset which is negatively correlated, i.e. it goes up when the stock market goes down. Specifically, the nightmare about put options is most of the time the market doesn't crash. So when you buy put options, you might as well assume it's not going to cash in. It's a bit like an insurance, house insurance. You don't want to overpay for your house insurance. So from that point of view, we tend to only buy put options when that we consider them to be ultra cheap. That has been the case for the last few years. And clearly came right last year because unfortunately the market did have a big setback with the global pandemic. So we cashed in last year, and since that time we haven't had a put option in the fund. In part, we're somewhat upbeat about the UK, but even then, of course, things come out clearer. Sometimes markets go down for reasons we can't anticipate. But right now, the cost of a put option is still too high. And as I say, we don't want to put cash to work if it's the chances are that it doesn't work out for us. So we keep cost to minimum, and the cost of put option at the moment is too high for us to put into the fund.
Sure, I think that probably leads us nicely into the portfolio itself. Have you made any interesting changes of late, or are there a couple of stocks that you're particularly excited about going forward?
I mean, the key issue about the fund is it doesn't really have many consumer stocks. We've been the margin disappointed. We just haven't found as many consumer stocks as we expect. Clearly, the consumer recovery is upon us, and it'll be very strong when it comes. Unfortunately, many of the companies we've identified tend to have quite a lot of C-bills, and they've got quite a lot of VAT they've deferred. And generally, the cash which they will generate in the next few months probably isn't going to come back in shareholders. It won't be dividends. It'll be going back to the government or whatever. So from that point of view, we haven't found many in the consumer sector. But the areas where we have been more upbeat is in the financial sector. We continue to find new holdings in the financial sector which are very, very undervalued. So examples might be XPS, which is a pensions administrator. Brilliant business. It made an acquisition about 2 or 3 years ago now, which didn't go well straight away. The cash paybacks are coming now, but people have given up on it. And you can still buy it at a valuation which has been much unchanged for the last 2 or 3 years. So valuation really about 12.7 times to the period to March of this year, 2021, with a 5.5% yield. I mean, just perfect for us. Well positioned to grow well, strong market position. Hopefully as it generates more cash, that dividend will go quite nicely. Another area where we have some good weightings has been very much on the commodity sector. So things like materials have been a good area for us, and we've got quite a few mainstream material stocks, but we've also got some companies sort of bit out of the limelight, like Kenmare, which is involved in Immonite, which is still overlooked in our view. And then we've also got a few stocks in things like industrials. These aren't industrials as you and I don't know them. These are lawyers and finance, in fact, is the largest holding in there, which has grown its dividend beautifully and is forecast to go now. So quite a lot of stuff which is slightly cyclical, but not much in the consumer sector.
Great. Just on the sectors, Gervais, is it, are you tied down to a specific sort of split just in relation to the correlation point earlier? Do you like to have as broad a spread as you can, or what's the thinking there?
Yeah, I mean, we're really driving the outcome for clients as generating a nice premium yield and growing it faster than most other funds. So there is quite possible that certain sectors we have almost no exposure to if we find that there's just no dividends coming out or dividend cuts are coming out of that sector. So we're not, we don't have to have any sectors. But what we are looking to do is invest across a wide range of different industry types, diversifying risk so that, you know, if we get caught out, and we will get caught out sometimes, it's not going to make a big difference to the outcome for the overall portfolio. 130 holdings, as I say. So from that point of view, it tends to be very, very widespread. And most particularly, you know, having a multi-cap approach allows us to not just invest in the mainstream income sectors in the FTSE 100, but actually various income generators in the A market and such like. And it's that sort of broad diversification which allows ultimately the income of the fund to be reliant on lots of little holdings rather than any specific holding, but also for many of the companies to continue to grow even when there's a global recession on. These are immature businesses, younger businesses, and they're often able to supply markets which are growing even at a time when the main global economy is under pressure.
Great. I imagine that similar mindset to your ESG approach, is it, Gervais? How do you see the UK as a whole dealing with ESG, and is it a major thinking in your stock selection?
Yeah, I mean, when we meet companies, a key issue about dealing with corporate governance and such like is we want companies to identify risks and then we want them to manage them. We can't eliminate risk, and we don't want to eliminate risk, because if we eliminate risk, we eliminate return. But we do want to manage risks and scale them back as best we can. And so, as a financial sector, the UK has been probably leading the world in terms of corporate governance ever since the Cadbury Report in '92. And therefore, we feel that the UK is pretty good in this area, actually. I think with climate change and the need to kind of manage down carbon footprints, I think the UK fund management sector will probably lead the world in this area. I think it's another way of reducing risk. I think there's quite a lot of reputational risk if you don't get it right in these areas. So I think companies should be reducing it. And most particularly, there's a large number of mainstream companies which probably need to invest quite hard to reduce their carbon footprint. And that's really what the stock market's for. If you've got the ability to invest for an attractive cash return and you can keep ahead of your competition, let's get on with it. So coming back to that point, I think the UK fund management sector will lead the world. And I think that will make it easier for many of the mainstream sort of investors of the world to actually invest in the UK versus other territories.
Great. And another quite topical point at the moment is inflation. Is that a concern of yours and the trust, or?
Yeah, I mean, it's interesting. If you look at things like inventory levels, at the moment they're at very low levels. The pickup when it's come has been very aggressive, and there have been bottlenecks which have been very severe. You know, we've all heard about the chips and the car makers not being able to manufacture as many as we like. But actually, if you look at the commodity markets, the backwardation on commodity markets, that's the willingness to pay up right now a premium relative to delivery in a month or two's time after the storage costs, is actually at probably a 14-year high. In other words, it takes us back to 2006 and 2007. So I think there's a lot of shortages around. I think there will be some manufacturers get caught out. They'd like to manufacture. They've got customers asking for product, but they can't deliver. So I think it's going to be quite a difficult area from that point of view. But on the other hand, I do think that does lead to inflationary pressures. So I do think the short-term spike with inflation will probably be a little stronger than most people think, and it may upset markets. The big question is whether we get long-term inflation. We'll have to see. At the moment, we just don't know. But once you let the inflation genie out of the bottle, it is quite difficult to get it back in again.
Sure. And what about performance of the trust, Gervais? Could you highlight for the listeners how you've performed? I know you've previously been on a discount for a while. Is that still the case? And particularly with the dividend cuts of last year, where do you stand on the dividend as well?
Yes, I mean, it's interesting, really. Equity income strategies generally have been a bit out of fashion. Obviously, we had a lot of dividend cuts last year across the UK market generally, and so that's meant they've been somewhat lagging the market last year. What we have seen is the ability to invest in companies which are sustaining dividends or growing their dividends has led to actually some quite strong performance. The fund itself, the trust, has outperformed many others over the last 12 months. But actually, we're just going through our 10-year anniversary. And what's reassuring is to see that the strategy has actually generated added value relative to the competition pretty much over the 10-year period in quite a major way. So it's been a strong performer. Clearly, that doesn't guarantee anything for the future, but it does put some reassurance that actually the process of investing across a multi-cap approach has been offering us an opportunity set where we can add value.
Great. Yeah, I think that's a great place to end. Thanks very much for your time today, Gervais, and best of luck with all your work going forward.
Thank you very much. I very much enjoyed it.